Hi everyone! In today's video, the second of the Outperforming the Market series, we will be covering something critical to the stock market. Have you ever wondered how the price of a stock is determined? Well, today we will cover that exact topic and explain why people overselling stocks in bear markets offer a great opportunity for long-term investors to enter into strong companies at even stronger prices. Today's video is going to be a little long and a little complicated at times, but I promise you, if you stick with it to the end, you won't regret it. I'll start by first explaining the important concepts we need to understand to appreciate the logic behind pricing stocks. I'll provide examples along the way, but if you have any questions about anything I cover in this video, please post them in the comments below and I'll get to them as soon as possible. We can start by looking at the equation for a stock price written out as a simple sentence. A stock price is equal to the sum of its discounted free cash flows from now until infinity less its net debt. This is a very difficult definition or equation to understand at first because it's difficult to comprehend how we can price or pay for something into infinity when we struggle to predict what will happen within the next month or year. So I'll start by defining these terms so that when we look at the proper formulas, we can understand why the current overselling in the stock market is illogical. First, we must cover the concept of discounting. Discounting combines two important concepts in the world of finance. The first of which is the time value of money, which essentially states that $1 today is worth more than $1 tomorrow due to inflation and the opportunity cost of not being able to invest that money risk-free today. The second of which is the weighted average cost of capital, commonly known as WACC. The WACC represents two concepts. First, the risk a company must take to generate recurring cash flows from their assets. Second, the expenses a business will take on to finance the purchase of their assets. For example, companies may have to offer debt to initially purchase their assets. I will cover how we determine an appropriate WACC for a company in detail in my Value Investing Guide series. For now, let's look at an example of discounting in action. If you could buy a machine that allowed you to earn $1,000 per year in free cash flow for 10 years, but it costs you $9,000 today, should you immediately agree to buy this machine? At first glance, this may seem like a great deal as you get $10,000 for $9,000. But is this really a good deal? As you can see, if we assume a 5% discount rate, then buying this machine actually causes us to lose money. How did we get the 5%? First, because our free cash flow is fixed at $1,000 per year, we must factor in an inflation rate. The average rate of inflation in Canada and the US is usually around 2% per year. Second, I assumed I would need to finance the purchase of this machine with debt, which would cost me 3% per year in interest. In total, this results in a 5% discount rate. After discounting these cash flows, it shows us that we are actually losing money by buying this machine. A key point to note is that discounting compounds on itself. So the cash flow in year one is much more valuable to us than the cash flow in 10 years. If we have any older viewers, I'm sure they can remember the good old days when they could buy things for just a nickel. Second, we must consider the concept of free cash flows. This is essentially the amount of cash that is left over for investors after accounting for all other business expenses, except for interest expenses and other expenses associated with raising money. These will be captured in the discount rate. So, in the example above, this would be the $1,000 per year of free cash flow that the machine generates for us or the company. Finally, we need to understand the concept of infinity when dealing with stocks. With many investment products, there's typically a maturity date at which point your principal, or some amount based on your principal, is returned to you. The principal is your initial investment into the investment product. However, with stocks, we assume something called the going concern principle. This is essentially an assumption we make that a company will remain in business for the foreseeable future. To understand why this is the basic assumption, we need to understand why a company would ever stop operating. Either the firm goes bankrupt or the firm gets bought out by another firm and stops trading. Neither actually happens for most corporations that trade on the New York Stock Exchange or the TSX in the short term. This concept is important because it changes how we must discount cash flows for stocks. Understanding this is also what helps investors stay calm during bear markets and stock market crashes that affect many other investors. The way we discount stocks into infinity is by using a perpetuity. I will explain this concept using a simple example. If I offer you $100 every year on December 31st, from this year until the end of time, and this promise is backed by the US government, how would you calculate the value of this offer? I'll give some math lovers an opportunity to guess the value of the offer right now, so pause the video and see if you can figure it out. Ready? So that was just a joke. Surprisingly, you don't need to be mathematically inclined at all to use this formula. So here's the solution. The present value of this opportunity ends up being worth $5,000. I used a 2% discount rate here because that's typically what the US long-term bonds yield, which are considered risk-free investments because the US government has never defaulted on a payment. So we just take the $100 and divide it by our risk-free rate of 2% to get our present value of this opportunity. Here's where things get interesting though. Imagine I tell you that I can't work for half of this year and just this year, but then I will be working full-time guaranteed for the rest of time. So I will pay you $50 this year to account for that, and then $100 again each year for the rest of time. How much does the value of my offer change now? So in this case, we discount the $50 back to today using 2%, which equals $49.02, and then we calculate the value of the perpetuity next year using $100 and a 2% rate, and then we have to discount that back to today to account for that 1 year of inflation. So the overall value of this opportunity ends up being $4,950.98. This equates to a negative 0.98% change from opportunity 1 to opportunity 2. We can update this example to use a discount rate that's more appropriate for stocks, which have some risk associated with them. For simplicity, we'll say this is 10%. It's likely closer to 8% given a concept called the equity risk premium, but don't worry, we'll cover the complex version of this lesson later on. Using 10%, we see a negative 4.55% change in the value of the two opportunities. So let me ask you a question. Are we seeing a 5% reduction in stock prices right now, or are we seeing drops of over 30%? We're seeing the latter, and this just isn't justified based on the math. The reason why this is such a powerful time to invest is because over the next few years, the economy will recover from the short-term shock, and we'll see prices return to the initial scenario, allowing you to earn strong returns on your positions entered at this time. Always remember that as a general rule, 50 to 75% of a stock's value is trapped in this perpetuity equation, also known as a stock's terminal value. A smaller part is trapped in the initial forecast we use for the stock, which in the example I used above would be the $50 component versus the $100 for life. When we cover how to do this for individual stocks in detail, I promise you'll feel a lot more comfortable about whether or not the price you're paying for a business is fair. Never worry about the bottom, because that is determined by what others think. Do your own analysis and make sure to refer back to it when markets are acting irrationally. There's nothing more lucrative and powerful than understanding the true value of a business when others do not. Before we end for today, I just wanted to discuss that there are some real issues and risks that you should be aware of in the market today. For example, interest rates are extremely low, which limits the effectiveness of monetary policy, which is a set of tools that the Federal Reserve or other government-run banks use to reduce the negative impact of a recession or to avoid a recession completely. Another big issue is the increasing popularity of ETFs and the negative impact that they have had on price discovery. While I think ETFs are a great tool for investors to utilize, there are some real risks associated with them that I will cover in another video at a later date. There's also the consideration that both companies and individuals are incredibly levered up right now. What's a simple way you can shield yourself from some of these risks, but also buy companies at great prices? You can focus your money at companies that serve society's needs that are being unjustly sold off due to investors panicking or equal weight ETFs and sector funds needing to rebalance their portfolios. For example, we will always need food, so grocery stores are likely companies that have been unjustly impacted by this situation. If you want to see what I've been buying over the past couple of weeks, leave a like down below and a comment so I know that you want to see this. Just remember that there are always risks in any investment strategy you can undergo. What's important is that you seek a return that is at least proportionate to the amount of risk you're taking on. So, if you enjoyed the video and it gave you a little more confidence about investing in the stock market during these times, please drop a like down below and share the video with a friend. If you didn't enjoy it, leave a dislike and be sure to let me know how I can improve down below in the comment section. As usual, please drop your thoughts in the comments and I'll reply to you as soon as I can. Let me know what you've bought so far and if you're going to be adding some additional positions to your portfolio after learning about this. If you're looking for a company to consider adding and you're new to the channel, check out the video I made a few days ago on Berkshire Hathaway. Let me know if there's anything else that you want to be covered in the short term. Until then, I will begin covering a detailed walkthrough of my and other famous value investors' investment processes with a detailed valuation of McDonald's Corporation. Take care, everyone, and remember, always be eager to learn, willing to invest, and prepare yourself for success.